The global economy in early 2026 looks virtually bulletproof. Equity markets are surging, propelled entirely by a massive, booming infrastructure build-out for artificial intelligence. Beneath this surface-level prosperity, an economic trap is waiting. It is a phenomenon known as a Minsky moment, a theory which states that long periods of steady, uninterrupted growth actually manufacture severe financial instability. The trap functions through complacency. When markets feel invincible for too long, investors stop looking for risks. They borrow heavily, taking on massive hidden leverage to maximize their speculative bets, while disregarding the potential for black swan events. Today's record-breaking market highs represent the exact mechanism manufacturing the next collapse. After the real estate crash of 2008, global regulators locked down the traditional banking system. They put strict capital controls in place to guarantee that a housing-style collapse could never happen again. While the regulatory cleanup worked on paper, the underlying financial risk survived. It simply migrated. That risk moved out of the highly regulated traditional banks and into a dark territory, officially known as non-bank financial intermediation, the shadow banking sector. This diagram illustrates the scale of that migration. A standard regulated bank is now dwarfed by the shadow banking sector, which has quietly swelled to a staggering $238.8 trillion. With nearly half of all global financial assets now operating outside of regulatory visibility, the safety nets built after 2008 have become obsolete. The epicenter of this hidden risk lies within a specific, booming ecosystem of the shadow sector, the $3 trillion private credit market. On the surface, the private credit market looks incredibly stable. Reported default rates remain very low, projecting a narrative of safety to investors. This chart exposes the rot beneath that surface. When we look at the total corporate borrowers in this market, a massive 40% of these companies actually operate with negative free cash flow. These bleeding companies avoid default through a systemic loophole called payment in kind, or PIK arrangements. Under a PIK arrangement, cash-poor companies are legally permitted to pay their interest obligations by taking on even more debt instead of using real money. When you strip away this phantom debt, the true default rate is revealed to be approaching a critical 5% threshold. This $3 trillion ecosystem operates as a sophisticated delay of mass corporate bankruptcy. These shadow banks and private credit funds do not exist in an isolated vacuum. This network map reveals the umbilical cord connecting the systems. Shadow banks borrow multi-trillion-dollar sums from traditional banks to amplify leveraged bets. When the PIK debt illusion shatters, real corporate defaults will force shadow banks into a desperate fire sale of assets to cover loans. The structural ties between these sectors ensure a failure in the unregulated shadows will detonate directly inside the traditional banks we rely on every day. In 2008, the system survived because global governments acted as the ultimate rescuers, injecting trillions into failing banks. Today, those same sovereign rescuers are drowning in public debt levels not seen since the aftermath of World War II. In 2008, debt-to-GDP ratios were low enough to absorb massive stimulus. Today, with public debt exceeding the total size of the economy, printing trillions more would flood a system that can no longer absorb the liquidity, causing a rapid currency devaluation. The impending market crash will occur in an environment where the institutional firewalls used in the past have already been exhausted. When the system breaks this time, the institutional tools required to save it will be effectively paralyzed. No one is coming. Right now, global stock markets are printing new highs with a mechanical consistency. Every week seems to bring another peak, brushing off any whisper of a slowdown. Look where that money is flowing, heavily concentrated in physical infrastructure. Trillions of dollars are pouring into pristine data centers to power the AI boom. But this chart shows the timeline of global public debt over the last century. While Silicon Valley builds the future, national ledgers drag into the past. Government debt has spiked to levels unseen since the immediate aftermath of World War II. Step outside the data centers, and the economic distress becomes deeply visible. In the financial capitals where market algorithms generate billions, the physical economy is struggling to support its citizens. Which brings us to a massive contradiction. If sovereign balance sheets are stretched to their historical limits, and the physical economy is cracking under the strain, what is actually holding the stock market up? During 2008 and 2020, central banks became the ultimate financial safety nets. They slashed interest rates to zero and printed trillions to absorb the shock. That rescue worked, but it drained the treasury. Governments spent their emergency reserves to float the private sector, leaving their financial ammunition completely exhausted. Now, these massive institutions are caught in a dynamic economists call the sovereign debt trap. They are carrying too much weight to move. If another systemic crisis hits tomorrow, they face an impossible calculation. Dropping a new multi-trillion-dollar bailout into an already heavily indebted system would instantly trigger catastrophic hyperinflation. The math simply does not allow for another rescue. The institutional safety net investors relied on for 2 decades has been quietly packed away. Much of the liquidity from previous bailouts has migrated into the unregulated world of shadow banking, creating a massive, unmonitored pool of leverage. We are now walking a tightrope over that precarious floor, without any institutional harness to catch a fall. So if the entities that normally protect the economy are financially paralyzed, why hasn't the entire system tipped into a recession? Take a look at this market breadth chart, which maps out the performance of individual companies within the Breyer Index. The apparent strength of the market is an illusion, generated almost entirely by a handful of technology giants skyrocketing at the top. Below that narrow cluster, the vast majority of the index is flat or sinking. This single thin wire of tech growth is dragging the heavy, struggling volume of the remaining economy upward, completely masking the friction underneath. This is the AI mirage. By pouring capital into one highly visible sector, investors have talked themselves into a false sense of invulnerability. Equity markets are currently priced for absolute perfection. They are operating on the assumption that the digital expansion will continue indefinitely, without ever hitting a physical roadblock. It is a fragile glass house. Algorithms and server racks do not exist in a vacuum. They require immense amounts of real-world energy and hardware, completely ignoring the volatile physical planet required to keep them running. Step away from Silicon Valley, and the risks come sharply into focus. The real threats to this rally are physical geopolitical shocks. We are looking at a map covered in active landmines. From armed conflict expanding in the Middle East to highly erratic global energy markets, the physical world is fracturing. A single severe disruption, like a major shipping lane closing or a targeted embargo on oil or semiconductors, would instantly sever the physical supply chains that these tech platforms depend on to survive. The digital boom is entirely reliant on perfectly synchronized global supply lines and international peace. Both of those conditions are actively deteriorating. When a geopolitical spark inevitably lands, the illusion shatters. Realizing tech growth is blocked by physical reality triggers an immediate panicked sell-off. These tech equities are frequently used as the primary collateral for short-term lending in the shadow banking system. As their values plummet, that collateral evaporates, forcing immediate, brutal margin calls across the entire over-leveraged sector. Facing insolvency, those shadow banks will immediately turn to the government. They will demand a massive, coordinated central bank bailout to keep the financial arteries flowing, exactly as they did in 2008. But the trap is already sprung. The governments are financially tapped out, suffocating under their own historic debts, entirely unable to write the check. The systemic reality is that when the music finally stops, the entities that traditionally catch the fall are already bankrupt. Once the first domino falls, we are on our own.
Since the crash of 2008, the financial establishment has sold us a comforting story. Regulators stepped in, passed new laws, and supposedly built an impenetrable fortress around the banking system. We are told our deposits are secure, and the reckless gambles of the past are safely locked away. But the hazard never actually disappeared. Financial activity didn't stop seeking high-risk returns. It simply moved outside the reach of the new regulations, directly into the dark. This diagram shows the true scale of that shadow economy. Sitting right behind our heavily regulated traditional banks is a massive, unregulated sector known as private credit, a lending market that has quietly ballooned to $3 trillion. Because this massive pool of debt operates completely out of sight, it is highly sensitive to external shocks. A single macroeconomic spark, a sudden geopolitical crisis, or the abrupt popping of the AI technology bubble is all it takes to ignite it. The moment that spark hits, the market reaction isn't a slow, measured decline. Investors realize they hold risky, unregulated debt and rush for the exits all at once, triggering an immediate, panicked global sell-off. This panic forces lenders to issue a devastating wave of margin calls. A margin call is a strict demand for borrowers to immediately deposit cash to cover the rapidly dropping value of their collateral. Suddenly, thousands of shadow banks are forced to produce billions in cash they simply do not have. Operating entirely without a government safety net means there is no circuit breaker to halt this drop. In this environment, a localized moment of market panic triggers a chain reaction of liquidations that fuels further losses. Hit by those relentless cash demands, lenders snap their wallet shut. The entire $3 trillion private credit market instantly freezes, cutting off all new loans across the board. This flow chart illustrates how thousands of companies rely on a mechanism called payment in kind, or PIK. Many businesses with low cash flow survive by taking out brand new loans solely to pay the interest on their older existing debt. When the private credit market freezes, this continuous cycle of borrowing evaporates. Companies suddenly lose the ability to secure the fresh cash they require to make their basic interest payments. Most of these private credit funds are structured to absorb only a small fraction of losses before their equity is wiped out. Looking at this chart, you can see the impact when hidden corporate defaults are dragged into the open. As the rate breaches the 5% threshold, the losses begin to overwhelm the system's internal buffers. Desperate financial institutions are forced to raise cash to cover these mounting losses. They begin liquidating whatever assets they can sell, sparking a massive global fire sale across all markets. The failure of the PIK loophole strips away the illusion of corporate solvency. It acts as an accelerant, turning what could have been a temporary credit freeze into an avalanche of corporate bankruptcies. You might be wondering why an everyday depositor should care if a bunch of unregulated shadow banks and private credit funds go bankrupt. This diagram reveals the connection. Traditional banks moved capital into non-bank financial intermediation, or NBFIs, effectively bypassing the capital requirements designed to keep the banking system stable after 2008. Because the heavily regulated everyday banks act as the primary funders for these NBFIs, they never actually removed the risk from their own balance sheets. They just placed it in a separate, less visible pocket. As the NBFIs collapse from the credit freeze, the flow of risk reverses. The losses they accumulate pump straight back across the regulatory wall, directly infecting the traditional banking system that funded them. By utilizing these shadow channels to skirt safety rules, the traditional banking system created a direct conduit for the same contagion they were supposed to avoid. The toxic debt has completely breached the regulatory walls. The traditional banking system, supposedly fortified against another disaster, is now fully infected and stalling. Naturally, the public expects governments and central banks to step in. We look for a massive rescue package, exactly like the bailouts orchestrated during the 2008 crisis. But this chart exposes a critical difference. In 2008, governments had the capacity to borrow and spend. Today, they are already carrying record levels of debt relative to their entire economies. This creates what economists call a sovereign debt trap. Central banks find themselves paralyzed, with no clear path to absorb the private sector's losses without compromising their own solvency. In 2008, the world still had faith in government credit. Today, with debt at all-time highs, printing trillions of dollars to cover bank losses risks a collapse in the currency's value. When an economy is already at its debt limit, a sudden flood of new money leads to rapid, uncontrolled inflation that erodes the entire system. Regulators could have addressed this outcome by monitoring how financial risk crossed between regulated banks and unregulated funds. Instead, they focused on individual sectors while the systemic threats built up in the gaps between them. The system prioritized the short-term high yields offered by private credit over the long-term resilience of the economy. Leaders leaned into the appearance of a stable recovery, while the actual risk simply migrated into the shadows. Building a financial empire in the unregulated shadows ensures only one thing: A single flash of panic will bring the entire structure crashing down, and this time, no one has the resources left to stop it.